All right, so we're going to get started. So I just want to welcome you to our Calculating Your Carbon Footprint 101 webinar. This is kind of an intro to GHG accounting that we're doing here today. So just going over our agenda for today, we're going to start out with some introductions of our presenters and panelists. Then we're going to go right into the content. So we'll be doing a carbon footprint or greenhouse gas emissions, explaining what that is. Where is GHG inventory on your climate journey? So explaining how that kind of fits into your overall climate journey, and then also how to create a GHG inventory, followed by our Q&A session. So our speakers today, hello, my name is Lisa. I am the Content and Marketing Manager for Climate Huddle. We're going to be joined today by Anna Burch, who is a consultant at South Pole, which is excellent. We're really happy for her to be here, to be able to present to you. And then we're going to be joined for the Q&A as well with Pablo Päster, who's the practice lead for Climate Huddle. So Anna, we'll pass it over to you and get started.
Thank you, Lisa, for the introduction. It's my pleasure to be here today and run you through the basics of greenhouse gas accounting in the next half an hour. As Lisa mentioned, I'm a sustainability consultant based in Zurich, and in my daily work, I help companies to calculate their greenhouse gas footprint, set climate targets, and develop reduction roadmaps. Therefore, I'm thrilled to have you all here and see that the topic of greenhouse gas accounting enjoys great interest. So let's jump right into it and start with the first but most important question. What do we mean by a carbon footprint? Let's start with a bit of greenhouse gas lingo. I'm sure you have all come across terms like carbon footprint, greenhouse gas emissions or GHG emissions, CO2 equivalent emissions, carbon emissions, greenhouse gas inventory, or many other similar terms. Might sound confusing, but the good news is in the overwhelming majority of cases, these terms refer all to the same thing, to the carbon dioxide equivalent emissions of a company, or short, the greenhouse gas inventory. And the procedure to create a greenhouse gas inventory is called greenhouse gas accounting. But what's measured? A greenhouse gas inventory, or as we might call it throughout this presentation, a GHG inventory, quantifies the total amount of greenhouse gases emitted by a company, typically over the course of 1 year and measured in tons of carbon dioxide equivalents. And for companies that want to become committed to sustainability, a greenhouse gas inventory is an important instrument to evaluate and understand their climate impact. What it shows is in what areas companies produce greenhouse gases and where the greatest potential lies for reduction measures. So let's start with the basics. Greenhouse gases are gases in Earth's atmosphere that trap heat and contribute to an increase in average global temperature. This is because these gases let sunlight pass through the atmosphere, but they prevent the heat that the sunlight brings from leaving the atmosphere, a phenomenon which is commonly known as the greenhouse gas effect. There are 7 major greenhouse gases, which I will present to you in more detail. These are first carbon dioxide, which is not only the best known, but also the most common greenhouse gas that is produced when burning fossil fuels. Methane is the second most abundant greenhouse gas after carbon dioxide, accounting for about 20% of global emissions. Methane is emitted during the production of fossil fuels or results from livestock or other agricultural practices, land use, and waste landfills. Nitrous oxide, commonly known as laughing gas, is also primarily emitted from agriculture and land use activities. And then we have the group of the 3 so-called refrigerant gases, which are first the HFCs, commonly used for cooling and refrigeration, the PFCs, mostly emitted through manufacturing processes, and the CFCs, which are not only exceptionally strong greenhouse gases, but also responsible for the destruction of the ozone layer. Last but not least, we have sulfur hexafluoride, which is commonly used to insulate electric switchgear. It's important to note here that these greenhouse gases are not equally strong in their effect on the climate. Their effect depends on how long these gases stay in the atmosphere and how potent they are in warming the global climate. Their global warming potential is expressed in tons of CO2 equivalents. And what that means is a CO2 equivalent is a unit of measurement that is used to standardize the global warming potentials of various greenhouse gases. And what it does is it converts emissions to the equivalent amount of carbon dioxide. For some greenhouse gases, the global warming potential is significantly higher than that of CO2, in the case of methane by a factor of 21, and in the case of sulfur hexafluoride, the strongest greenhouse gas, by a factor of 22,800. But why should a company care about greenhouse gases? That's the first question to answer. So, what gets measured gets managed. That's a common saying, and for corporate sustainability management, that really is true. Because to manage your climate performance, your company must first understand the greenhouse gas footprint of its activities. A comprehensive greenhouse gas accounting therefore presents the first step in the development of any successful climate strategy. And here on the slide, you can see the 5 steps of South Pole's climate journey and the greenhouse gas accounting as a start of it. By identifying emission hotspots and showing where the greatest potential for reduction measures lies, a greenhouse gas inventory provides the basis for formulating well-founded reduction targets, which presents the next step on the climate journey. It also informs the modeling of a reduction roadmap to achieve these targets, and most importantly, it allows to track progress over time. So it allows you to monitor how your company reduces its climate impact over time. In a 4th and 5th step on the climate journey, companies can then finance climate action and finally engage stakeholders in their climate vision. Next slide. Like in financial accounting, there are different greenhouse gas accounting standards out there. But which standard is best to follow? When it comes to greenhouse gas reporting frameworks, companies are advised to follow the Greenhouse Gas Protocol, which supplies the world's most widely used greenhouse gas accounting standard. This greenhouse gas accounting methodology has been around for more than 2 decades now. It was jointly convened in 1998 by the World Business Council for Sustainable Development and the World Resource Institute. Its guidelines, specifically the corporate standard and the Scope 3 standards, are used by companies, governments, and organizations all over the world to translate their activities into quantifiable inventories of greenhouse gas emission data. You can find both of these guidelines online, but throughout this presentation, you will learn about the most important concepts of the Greenhouse Gas Protocol that will then allow you to set up a greenhouse gas inventory for your company that is in line with the international standard. How to create a greenhouse gas inventory. So now enough of the theory, let's focus on the practice and on the process to create a greenhouse gas inventory. And no worries, you'll see in a minute that there is no magic in calculating a company's footprint. It basically just involves deliberate data management and simple math. Here on the slide, you see the 5 steps to set up a greenhouse gas inventory in practice. The procedure is quite straightforward. So first, the necessary resources need to be assigned. Then the scope of the emission inventory needs to be defined. The third and most consuming step includes the collection of data. And then, based on the data available, the emissions can be calculated. And as a last step, then the results can be officially reported before starting with the data collection for the next year. Because always keep in mind that greenhouse gas accounting is not a one-time thing. It is similar like financial reporting, an annual repeating process. Because by doing a footprint every year, you can monitor and track your emissions and the progress you made in reducing them. But let's take it easy and go through this process step by step. Let's start with the first step, the necessary resources. The first thing you want to look at when preparing for a greenhouse gas accounting is securing management support. It is important to have the necessary personal and time resources available, which are needed to run the accounting exercise. Greenhouse gas accounting is a cross-divisional exercise, as you will understand later on throughout this presentation. And a greenhouse gas inventory is always of interdisciplinary nature because we need data from all business units and teams if we want to have the full picture of a company's climate impact. For example, purchasing data from procurement, energy data from different facilities and sites, or employee commuting data from HR. In terms of personal resources, it's therefore great to have a central team in place that coordinates the emission reporting and establish standardized processes and templates for an efficient data collection. Besides the central team, though, it's important to assign a data owner in each team or division that is responsible for collecting the data throughout the year and submitting it for the GHG accounting. So once you secured management report, gathered a cross-divisional team and established clear responsibilities and standardized processes, you're almost set. Yet before you start, you may want to prepare a budget and embed the greenhouse gas accounting in your broader business strategy. As a second step, the scope of your company's greenhouse gas footprint needs to be defined. How do you differentiate between emissions your company is responsible for versus those that are the responsibility of other companies? Or how do you know what to measure and what not to measure? These questions are not always straightforward to answer, but they must be addressed to prepare a greenhouse gas accounting exercise. The concept of boundaries helps to answer these questions. There are two types of boundaries to consider, which are the organizational and the operational boundaries. Organizational boundary, here illustrated in the left-hand box, they refer to whether company operations are owned by your company and therefore should be included in the inventory. Whereas an operational boundary defines the scope of direct and indirect emissions within the defined organizational boundaries. Might sound a bit confusing in the beginning, so let's illustrate the concept of boundaries with an example. In terms of organizational boundaries, your company may want to include any facilities that you have control over and exclude those for which you haven't. For example, facilities of partner companies in which you have a minority interest only. Within the organizational boundaries, we then want to classify emissions according to direct and indirect source. And this is where the operational boundaries and the illustration on that slide come into play. We see the distinction between direct and indirect emission sources, which is crucial for the concept of boundaries. Direct greenhouse gas emissions are emissions from sources that are owned or controlled by the company. And indirect greenhouse gas emissions are emissions that are a consequence of the activities of a company, but occur at sources which are neither owned nor controlled by your company. To help further delineate operational boundaries, direct and indirect emissions are broken down into scopes. And the Greenhouse Gas Protocol has defined 3 scopes of emissions. And those scopes, they correlate to who actually owns those emissions and the level of control a company has to changing those emission levels at each stage. We see the 3 scopes and their respective subcategories illustrated on the chart. Scope 1 in the middle of the chart refers to the direct emissions from an organization's operations, including company vehicles and buildings. Scope 2 categorizes indirect emissions from purchased electricity, heating, and cooling. And finally, Scope 3 comprises all other indirect emissions that exist in a company's value chain, such as upstream material collection or downstream product use, for example. So before starting with the data collection, your firm has to decide what scopes and emission categories are relevant to their business. But first, let's dive a bit deeper into the concept of the different scopes. Scope 1. As already mentioned, Scope 1 emissions are direct emissions, those that a company causes by operating the things that it owns or controls. These can be a result of running machinery to make up products, driving vehicles, or just heating buildings and office spaces. The data we need to calculate Scope 1 emissions are typically energy bills specifying the amount of fuels consumed by heating systems, for example, or the amount of gasoline or diesel consumed by company-owned vehicles. When it comes to Scope 2 emissions, these are indirect emissions created by the production of the energy that an organization buys. Typically, this includes emissions associated with purchased electricity or district heating. These emissions are indirect as the emissions physically occur at the facility where the electricity is generated and not at the facility of the company that reports those Scope 2 emissions. And to calculate Scope 2 emissions, we use, for example, electricity bills from utilities that specify the amount of electricity consumed, and importantly, also the type of electricity, such as whether it's renewable or grid electricity. Last but not least, the category of Scope 3 emissions. Scope 3 emissions allow for the treatment of all other indirect emissions. And as already mentioned, Scope 3 emissions are a consequence of the activities of your company, but they occur upstream or downstream the supply chain in sources which are not owned or controlled by your company. For many businesses, therefore, Scope 3 emissions are difficult to assess. But nevertheless, for many businesses, Scope 3 emissions account for more than 70% of their greenhouse gas footprint. For example, for service-based companies, Scope 1 and 2 emissions are generally low, and the majority of emissions occur in Scope 3 through purchased goods and services, such as office materials and IT infrastructure, or emissions associated with business travel. Scope 3 data, as already mentioned, is typically the most difficult to obtain because Scope 3 emission sources are often under the control of suppliers or customers. Therefore, in many cases, there might not be any primary consumption data available, as it is the case for Scope 1 and 2. And we might not know the exact number of products or type of activities purchased. However, there are two strategies that can be used to circumvent these challenges in Scope 3. First, many companies refer to spend-based data, such as the amount of dollars spent on different product types or business activities. And by using spend data, proxies, or even sector averages, we can then extrapolate the underlying consumption data and the respective emissions. And the second strategy is to conduct an employee survey that asks employees about their commuting habits or business travel activities, which then in turn allows to calculate emissions for Scope 3 categories of employee commuting and business travel. This brings us to the next step, the data collection phase, which begins once a company has defined its organizational and operational boundaries and knows for what utilities and emission categories data needs to be collected. The data collection phase usually takes up most of the time involved in a greenhouse gas accounting exercise. As mentioned before, for Scope 1 and 2 emissions, companies can typically refer to primary consumption data, such as utility bills or fuel purchase invoices. When it comes to Scope 3 emissions, however, these types of primary consumption data is often missing. Alternatively, firms have then the option to conduct employee commuting surveys or gather business travel data through travel agency report. Procurement data, moreover, may provide insights on the number of IT goods or raw materials purchased. And this is also why it's crucial to have a cross-divisional team involved in order to create an accurate greenhouse gas inventory. Coming back to the point I made before. Because Scope 3 data sources are typically located in different business units, such as procurement or HR, for example, and therefore require the involvement of many different stakeholders. Once the data for all relevant scopes and emission categories is collected, we come to the core of any greenhouse gas accounting exercise, the emission calculations. Emission calculations are basically a simple multiplication of the collected activity data at the one hand and the emission factors at the other hand. Emission factors are the magic factor that convert activity data to emission values. And what they do is they specify the amount of emissions produced per unit of activity. For example, how much emissions are emitted through the combustion of 1 kilowatt-hour of natural gas, or by driving a gasoline car, for example, for 1 kilometer. And these factors can usually be accessed through public databases. Now we have to remember that not all greenhouse gases have the same impact on the environment. And this is why emission factors are typically expressed in tons of CO2 equivalent emitted per unit of activity. As such, they account for the full climate impact of all emitted greenhouse gases and their respective global warming potentials. So let's try a simple emission calculation. Let's take the example of a transportation company that likes to calculate their Scope 1 emissions associated with the operation of their transport fleet. And let's assume that they have successfully collected the consumption data as they went through all fuel purchase invoices for their reporting year 2021. And they learned that their transportation fleet has consumed 10,250 liters of gasoline in 2021. So in the next step, we would multiply the 10,250 liters with the emission factor for 1 liter of gasoline, as illustrated on the slide. Through this simple multiplication, we then obtain our result, which is that in 2021, 23.98 tons of CO2 equivalents have been emitted through the gasoline combustion of the company's transport fleet. So that's a very simplified explanation of how those emission calculations work. But the approach, it's clear, it's just a multiplication of activity data times the emission factor. So let's assume that you have calculated the emissions of all relevant categories. How do you know how accurate your footprint is? The accuracy of your greenhouse gas inventory critically depends on the quality of the data at hand. The more granular the data, the more accurate your footprint and the more your emissions become a management metric rather than a reporting metric. And this is crucial if you are to manage and reduce material emission scopes. So if we go back to our example of the transportation firm that wants to calculate Scope 1 emissions associated with the operation of its fleet, let's assume that if they had primary data on the amount of liters of gasoline combustion at hand, as in the previous example, this would lead to an accurate Scope 1 footprint. So primary consumption data is what all firms should strive for. However, if we assume that this company had no data available on the vehicle type, fuel type, nor the amount of fuel consumed, this would necessarily lead to a less accurate picture of the firm's Scope 1 emissions, because then the transportation firm would have to refer to sector averages of vehicle emissions or try to extrapolate emissions based on spent data. And this again underlines the importance of constantly improving data collection processes to be able to increase the data quality year by year and to improve the accuracy of the footprint. Finally, the fifth step, if you have finalized the greenhouse gas accounting and calculated the emissions for the relevant scopes and emission categories, it's time to communicate the results and engage stakeholders in your sustainability vision. If we think about internal stakeholders, the GHG inventory represents an insightful management metric and may serve as an important decision-making tool for the management, procurement, for energy managers, or many other business divisions. For example, it may inform the implementation of efficiency measures that allow to reduce operating costs in the long run. When it comes to the communication with external stakeholders, go out there and become a leader in the fight against climate change and show investors, consumers, and supply chain partners that you monitor your greenhouse gas impact. Research has shown that a transparent reporting of a greenhouse gas footprint allows SMEs to meet investors' expectations and also enhance access to capital. More and more pressure is also coming from the side of customers, both B2B and B2C. Transparently reporting your company's climate impact may therefore allow to gain comparative advantage through increased stakeholder loyalty and improved brand image. How you communicate the results from your greenhouse gas accounting is up to you. Many companies are publishing the results in their annual reports or in a separate sustainability report, or they link it on their web page or even add a QR code on their products. So there are no limits to creativity here. It's important, though, that you stick to the truth to avoid greenwashing claims. Don't use claims as carbon neutral or net zero or any other claims without external verification. Rather, go out there and tell the world about the good work you do, share your vision, and be transparent about areas that you still need to improve in. So we're coming back to the climate journey. And here you see that actually the climate journey just begins with greenhouse gas accounting. So it's important to not stop, but rather continue on the climate journey once you have completed a greenhouse gas accounting. And most importantly, it's also important to keep in mind that it's an annual, it's a process that repeats annually, meaning that once you have set up the processes and defined the responsibilities, it will get easier over time. And at the same time, the quality of the reporting will increase. So it makes sense to really invest the resources in the first reporting cycle to be able to benefit from the insights of the footprint over all the upcoming years. So we're coming to the end, and I hope that by now all of you turned into greenhouse gas accounting experts and feel ready to start with the data collection. However, I just want to underline once more that greenhouse gas accounting is just the first step on the climate journey, and it's crucial to not stop there, because the real climate impact is created when the greenhouse gas inventory is used to inform a company's reduction strategy, and that should be the ultimate goal of any greenhouse gas accounting exercise. And with that, I'd like to close and leave enough time for your questions. Thank you all for staying with me. And with that, I hand it back to you, Lisa.
Amazing. Thank you so much, Anna. We're actually going to invite Pablo on screen. There he is. Excellent timing as well, just to kind of also be here to answer some questions. So if you do have any questions, please do submit them into the chat box. We have a few submitted already, which is amazing. And we'll get started. One of our first questions here is about being consulting business and scope 3. So if I'm a consulting business, what actually falls under my scope 3 emissions? Anna, if you want to answer this one.
Yeah, sure. Great question. Thank you. As mentioned in the presentation before, for service-based companies, scope 3 emissions often account for more than 70% of business greenhouse gas footprints. So focusing the data collection on scope 3 is indeed crucial. So if we think of a consulting business, we typically see 4 scope 3 categories that are particularly important, which are first purchase goods and services, then capital goods, business travel, and employee commuting. Also, you may want to report on the emissions from waste generated in your operations and any emissions that occur at leased facilities, if that's applicable to your company. And concrete examples of emission hotspots for a consulting business in scope 3 may include, for example, IT infrastructure, so the computers, monitors, and servers purchased, or emissions associated with air travel and hotel stays for business travel purposes. And finally, as already mentioned, depending on whether employees use their private car to commute to the office, employee commuting may also represent another emission hotspot.
Amazing. So another question is, our company leases office space in a building and we don't pay utility bills directly. Is there a way to calculate our natural gas and electricity emissions? And are they still scope 1 and 2, or are they scope 3? For you as well, Anna.
Yes, indeed. So those emissions have to be reported and included in the greenhouse gas inventory according to the greenhouse gas protocol. Emissions from leased facilities fall under scope 3 because you or your company doesn't have direct control over these emission sources. So what you would do is you would calculate the emissions produced through heating and electricity use the same way as you would do it for scope 1 and 2, multiplying the consumption data with the emission factor. But then you would report it under the scope 3 emission category of leased assets.
Perfect. So we have a question here about data sources and emission factors. So what are good data sources for emission factors? Pablo, if you want to take this one.
Sure. Yeah. So the data sources are going to depend on the type of data, of course, and the location that you're in. So here in the U.S., for Scope 2 electricity emission factors, the most reliable source is EPA's eGrid program. If you're in the UK, there's the BEIS program that provides emission factors. So it's sort of patchwork of sources for those emission factors, and some organizations like Climate Huddle will be compiling those emission factors and making them available in future tools to be developed to make it quite a bit easier than going out and having to find all of them.
And just as a note on that as well then, so to help us at Climate Huddle, if you do have specific things you're looking for within the emission factors, do let us know, because we are happy to kind of curate and help collect what you actually need. So definitely let us know, post it in the community if you have any specific things like that you're looking for, that we can help you find. It's a great question. Another question here for Anna. So how do we capture / calculate employee commutes? You've touched on a little bit already, but
yeah, exactly. So as mentioned before in the presentation, employee commuting is indeed a tricky category in terms of data collection, because usually HR does not have data at hand about average commuting distance of their employees and their preferred way of commuting. Therefore, employee commuting surveys have established themselves as a proven best practice, and this does not need to be a sophisticated survey at all. An easy Google or Microsoft or whatever form is enough to send around and ask your employees about their commuting habits. So how many kilometers they travel, by what means of transport, and how often they stay at home working remotely. And the positive side of conducting an employee survey is that you engage your employees in your sustainability vision, and you inform them about their individual impact on the company footprint. So it's necessarily not a bad thing or not an annoying thing to do an employee commuting survey, but it might also help the broader sustainability vision of your company.
excellent. So we have a question here, and maybe Pablo, you can answer this one, that just asks about what the difference is between carbon neutral and net zero and that kind of terminology.
Yeah, so there's a lot of confusing terminology out there, not just carbon neutral, but carbon negative, carbon positive, and all of those things. Unfortunately, a lot of them are sort of marketing language that doesn't have an official definition behind it. So it's really difficult to give a solid answer to that side of things. But where we do have a good answer is on net zero. So net zero is a approach that is promoted by the Science-Based Targets Initiative, and it's based on science. So it's based on what the IPCC's scientists have been telling us, that we need to reach net zero emissions by 2050 in order to stay within the 1.5 degrees Celsius limit that was set in the Paris Agreement. And so what net zero means is that your emissions that you're not able to reduce, so your residual emissions, are balanced in some way. And that can be done by purchasing renewable energy for your scope 2, but also through the purchase of removal offset credits. So you're basically funding a project elsewhere in the world that is removing an equivalent amount of greenhouse gas emissions from the atmosphere as you are emitting.
Great, thanks. And just a reminder to everyone, if you do have any other questions, we're down to our last few here, so definitely put them in there. And if not, we're always here in future as well. You can always reach out to us with any other questions that you have. Another question for Pablo. I haven't started my calculations yet, but I feel like I might have questions kind of when I get there. Can I still ask those questions later?
Absolutely. You can always ask us questions, especially through the Climate Huddle community. So we'll be sending out a link to those of you that have not joined yet. The community is a great place where you can ask questions of South Pole experts, and we'll try to answer those as quickly as possible. We'll also turn some of them that have broader appeal into educational content, whether it's a future webinar or a blog post or a video, and that'll go into a knowledge base that can be accessed in the future.
Amazing. That was actually the last question that we have here. So Anna or Pablo, is there any last thing you want to say? Any last advice you want to give?
Yeah, happy to be with you on that journey and here for any questions or anything you need from our side. And as I mentioned before, it's an exciting journey, and the greenhouse gas accounting is just the first part of it. So let's get started and go out there and take the first step as a climate leader.
And I would just like to say thank you to everyone for joining, and want to inform you that the climate journey that Anna spoke about earlier is something that we're in the process of developing as a toolkit for small and medium businesses specifically. So we'll be starting off with a tool for calculating your footprint so that you don't have to go out and find emission factors and become a greenhouse gas accountant or accounting expert yourself. Then moving on to setting targets aligned with the SBTI, the Science Based Targets Initiative. We'll give you tips and advice on reducing emissions. For those residual emissions that you can't reduce, we will be hosting a marketplace for offset credits. And then finally, we'll be helping you communicate the great work that you've done and the ambitions that you have going forward. So we hope that you'll join us in the community so that you can get updates on that, and then we'll be able to invite you to be the first users of that tool once it becomes available next year.
Amazing. Thank you so much to Anna for your expertise and your time today, and to Pablo as well for your expertise and time. I know we are very excited at Climate Huddle to be releasing and building all those things that Pablo just mentioned. Thank you everyone for joining us today as well. If you do have any further questions, please don't hesitate to reach out to us via email at hello@climatehuddle.com, or of course join the community so you can connect with people, be the first to know about our upcoming content and blogs we're releasing. So thank you again, everyone, and have a lovely evening or day, depending on where you're at in the world. Thanks.
Bye. Thank you.